Welcome to everyone. In this video, we can see about the speculation and hedging. Speculation is nothing but it's a taking position in the market in order to make money on the rise and follow future prices of certain commodities. You can buy a contract at low price, then turn around, and then you can sell that contract at high prices. Simply, it's a buy low and sell high process. Then some of the roles of speculation, it provides risk capital and provides volume and liquidity, keeps some markets in alignment through arbitrage. Why we should need speculate means it can increase small amount of money to large amount of money and then supply more income to traders and the stimulation of the game. Some of the rules in speculation, you should use money you can afford to lose and you should know yourself before using speculation. Don't overcommit and don't trade too many commodities. Whenever you are not sure, you should stand aside and block out other opinions. Trade the most active contracts, then never put your entire position at one price, then never adding a losing position. Cut your losses short and learn to like losses important in the speculation. Use stop orders and get out before contract maturity. Then some of the manners in speculators trade: position trader, day trader, scalper, and spread. Then we move on to the hedging. Hedging is the risk management process which deals with reducing or eliminating the risk of uncertainty. The aim of this hedging is to restrict the losses that may arise due to unknown fluctuation in the investment prices and to lock the profits therein. It's the principles of hedging is offsetting. For example, taking an opposite and equal position in two different markets. Simple terms, it is hedging one investment by investing in some other investment. Then generally people plan to hedge, they should ensure themselves against a negative event. Hedging does not prevent the event from occurring, but it surely reduces its impact. Not only individuals, it can also use it for managers and large corporations to minimize the exposure to various types of risk and decrease the negative impact in their companies. And hedging is simple example for hedging is when you buy a life insurance policy, you support and secure your family's future in case of your death or any serious injuries in some accident. Then areas of hedging and their risk. First one is commodities. Commodities include agriculture products, energy products, metals, etc. These are commodities. Securities means it includes investments in shares, equities, indices, and then etc. This risk associated with this security is known as equity risk or securities risk. Then currencies. Currencies include foreign currencies. There are some various types in currencies risk. For example, currency risk, volatility risk, etc. Then interest rate. Interest rate include lending, borrowing rates. These risks are associated with these rates are known as interest rate risks. Weather also one of the factors uh, where hedging is possible. Then the three types of hedging. First one is forward. Forward is a non-standardized contract to buy or sell an underlying asset between two independent parties at an agreed price and a specified date. It covers various contracts like forwarding, exchange contracts for currencies and commodities, etc. The next one is future. Future is a standardized contract to buy or sell an underlying asset between two independent parties at an agreed price, standardized quantity, and a specified date. It covers various contracts like currency, future contracts, etc. Then third last one is money market. It is one of the major component of financial market today, where short-term lending, borrowing, buying and selling are done with the maturity of 1 year or less. Money markets covers a variety of contracts like money market operations for currencies, money market operations for interest, covered calls and equities, etc. Then some of the strategies in hedging. Hedging is generally refers to risk reducing techniques of investment. There can be no standardized strategy to hedge various financial instruments like forwarding contract, opinions, swaps, or stocks because the strategies require constant modification as per the type of market and investment which required hedging. Some of the few strategies which are follows through asset allocation. You can do this diversifying your portfolio with more than one type of asset. For example, you can invest 70% in equity and rest of 30% in other more stable asset. Then you can create a balance. And then through structures, you can do this by investing a portion of portfolio in debit and others in derivatives, where the derivative debit portion brings stability to portfolio and derivative helps in protecting it from the downside risk. Then through options, you can do this by buying a put option to protect a portfolio of the cash market. Then staying in cash. It is a no investment strategy. Here the investor does not make an investment in any asset. Then thereby keeps his hand with cash. Then thank you.